Hi you guys, welcome back to the program. My name is Brad. Today we're going to talk about banking stocks. Now, I personally own two individual banking stocks. We're going to talk about three different ones. As you guys have seen, banking stocks have taken a bath along with most of the other big companies due to the pandemic. Some of the headlines I've read out there: bank stocks had a tough start to 2020 and the second half of the year won't be much better. There's a lot of uncertainty at the moment, but bank stocks tend to weather the storms better than most. Could this be your chance to get in on the action? Now, you guys know I don't usually pay too much attention to the headlines and all the hubbub on CNBC, but here, let's talk about it. So I decided to take a look and see how our banking stocks have done this year. Now, the two that I own are JP Morgan and Bank of America, but we're going to look at three. We're also going to take a look at Wells Fargo. So if we look at the graph here, first of all, let's look at Bank of America, and we can see that it's down this year to a current price yesterday of $26.73 a share. You guys, that's down 22.54% for the year. If we look at JP Morgan Chase, that's down to a share price currently of $102.94, and that's down 23.5% for the year. Looking at Wells Fargo, it's down to a share price of $25.19. You guys, that one's down 51.27%. So you're down over half your money if you bought in at the highs at the beginning of the year. To give you an example of what that would mean to you, for example, if you bought $10,000 worth of Wells Fargo on January 2nd, your value would currently be $4,873. You would have lost over $5,100. So pretty substantial losses. What does that mean in the future? What's going to happen with banking stocks? Are they going to turn around? So I decided to do a little research and see what it says. And here's what I read. Expect a noisy second half of the year for big banks like Citigroup, Bank of America, etc. The first half of 2020 was far more challenging for that sector than it was for the rest of what was going on Wall Street. Wall Street was already bracing for the Federal Reserve to do a 1 or 2 point quarter cut during the year, somewhat good for the banks. And then the pandemic hit. The economy hardened in March, forcing the Fed to slash rates by 150 basis points. You guys, that's 1.5%, as you know, to near zero just to keep the credit flowing. The big banks swiftly halted share repurchases to brace themselves for the loans that they thought may go sour. Dividends, even after the result of the Fed's annual stress test last month, still remain somewhat of an open question as the banks are required to submit their capital gains again this year. All of this contributed to the banks falling farther and faster than the broad market or the S&P 500. Goes on to say, while the second half of 2020 may not bring the same level of chaos as the first half, Wall Street accepts that there will be some uncertainty, and households and businesses were granted loan modifications during the onset of the crisis, but so far there has been little visibility into which borrowers will be able to resume their normal loan payments. Mortgage forbearance appears to be leveling out around 9% according to the S&P Global Market Intelligence, but the status of some business loans remains undetermined. While some businesses such as dental offices, etc., have been able to reopen with some sort of resemblance to normal, other businesses, restaurants, etc., are slower to open and face capacity restrictions. It's just a grind the banks are going to have to go through, adding that banks face a multi-quarter process of assessing potential problem loans and adding to the reserves accordingly. Now, here's one thing I read that says, if there's a bright spot in the uncertainty, one can note that the Fed said the sector is well capitalized and a source of strength during this crisis, in sharp contrast to what it was during the financial crisis a decade ago. Goes on to say, analysts expect the largest U.S. banks to remain profitable on a full year basis in 2020 and 2021. However, this is a point in an economic downturn when lenders must increase their quarterly provisions for loan losses and reserves by large amounts. And all of that is going to come out of their earnings. So where does that leave us? We know they went down huge so far, and they're still down. For me, I look at it as a good buying opportunity. I think that the banks will recover eventually. Now that doesn't mean they're going to recover overnight for sure. It may take 2 to 3 to 4 years. But if I can buy more shares for almost half price, or in the case of the two that I own, about 2/3 of the price, I look at that as a bargain. So I'm going to be adding to them slowly. Now, I don't go out and buy a ton of anything at any time because you never know what's going to happen tomorrow. But I think dollar cost averaging and buying myself some additional shares of the two that I own in the long term, I believe will be a good investment. And remember, when I think long term, I'm talking 10 to 30 years, right? I'm not looking at what Bank of America or JP Morgan Chase is going to do this year or even in the next couple of years, you guys. What do you guys think? Banking stocks, are they dead? Are they going to turn around? Let me know in the comments. Do you own any banking stocks, and how have they been treating you? Let me know in the comments, you guys. Like I said, I'm going to stay with them because I always think long term. And when I can get stocks on sale, that's when I like to buy them. Remember what Warren Buffett says, when others are greedy, be fearful. And when others are fearful, be greedy. All right, you guys, I hope you got something out of this. If you did, drop me a like. Really helps the algorithm. If you're not already subscribed, you guys, hit the subscribe button. Ring that bell. You'll get notified every time I make a video. All right, we'll see you. Thanks.